thank you for the introduction and for everyone's interest. So I'm one of the co-fund managers on the Polar Capital Global Financials Trust. So just try and give a brief overview of that trust, of the financial sector, how we see it in the broader investment landscape. So the key themes that we're invested in, and why we think now is a very opportune time to be looking at the sector. So just in terms of brief background on the trust, a team of 5, well-resourced team at Polar Capital dedicated to looking at the financial sector. The trust was launched in 2013 as a vehicle to give investors that global diversified exposure to the financial sector. So we invest across all different subsectors, primarily equities, with about 5-6% in fixed income. There's a tender offer every 5 years, and there's a move now to pay an enhanced dividend to around 4%. So in terms of performance, the trust has generated around a 10% compound annual return since its inception, and since a corporate action in 2020, it's generated a 19.8% compound annual return, so slightly outperforming the benchmark index, the Lipper peer group, and the broader MSCI ACWI markets. And I think that's a really important point, which we'll come into later on. We are seeing a reassessment of the sector amongst the broader market environment. And we think we're seeing the ingredients there for a shift in terms of market leadership, which would be particularly beneficial to the financial sector. So just take a step back and look at the financial sector. It is a big sector. It is the second largest at 17% of global equities. And it's a very diverse sector, as you can see on the left-hand side. So banks make up around 40%, that's that dark blue portion. You have insurance, of which a large portion is non-life insurance. That gold is diversified financials, which includes a number of different things from exchanges, information service providers, asset managers, consumer finance. And you have payments, which came into the sector from the technology sector in 2023. We had invested in names like MasterCard and Visa for a number of years before that, but it just shows how the sector has evolved. There are many different themes within it. Some are geared to higher interest rates, some are geared to falling rates. There are structural growth themes within it, and so there's a lot for an active manager to go for. And so we think it's an exciting subsector and sector to be active within. So just to take a high-level overview of the portfolio, we've put some 4 key subsectors, some example holdings within it. So about 35% of the portfolio is within banks. We are overweight European banks at the moment. We think they're in a really good space. We have around 17-18% in US banks, which we'll talk to a bit later on as well. And the remainder is within rest of the world, some of the emerging markets we like in particular. Within insurance, which is 35%, we're particularly positive on some of the non-life insurance names, and within that, the reinsurers, which are benefiting from a favorable pricing environment at the moment. Also helpful from a portfolio hedging perspective, they're less geared by macro events, more driven by insurance pricing cycles. So diversified financials, about a third of the portfolio. This includes names like Ares, so alternative asset managers. It includes exchanges, consumer finance names. And then lastly, we have payments, some of the names you'll be familiar with, the MasterCard and Visas, FIS. So all do slightly different things depending on the environment. So taking a step further back and just thinking about global equities. So this looks at global equities by nominal market cap, looking at geography and sector. And so you can see that green bar is dominance, that is US technology. So that has been the place to be. But I think it's important just to put in sort of graphic terms quite how dominant that is within global equities. So maybe people underestimate, if you have a global equities portfolio, how much exposure you might have to one theme and how much concentration risk there is should there be rotation. So again, that plays to the theme that maybe we are seeing some change in the investment environment. If we come to the next slide, very long-term slide, going back to the 1936. So this looks at relative performance of value sectors relative to growth. So that blue bars are value outperforming growth. So you can see predominantly, value had a pretty good time until the financial crisis. Then you can see that circled red space there where growth has significantly outperformed. And that coincided with a change in terms of the inflation backdrop, the interest rate backdrop, and we've seen quite an anomaly from a historical perspective in terms of growth outperforming. Now, we think it's more likely that you get a normalization in inflation from this point. So that period of zero or negative interest rates in the long period of time is actually the anomaly. So reversion to more inflationary environments, interest rates 2 to 3%, that is more the norm. And that suggests a different investment climate than we've had for the last 10 years. And investors should really be thinking about this in terms of how they position going forward. If we think about inflationary factors, that could be reworking of supply chains, the green transition, could be defense spending, fiscal policy that we're hearing about at the moment. All of those are quite inflationary. I think that should be in the back of your mind as you're thinking about positioning. Now, this has already been recognized by the markets. So the gold bars are the financial sector. You can see that that has outperformed broader markets over 1 year, 3 years, and 5 years. It's also outperformed other value indices. So it is a key beneficiary of any rotation from growth to value. But a lot of that performance has been driven more by earnings upgrades than by a re-rating. So the sector still remains cheap. We think it doesn't reflect the improvement in the underlying environment. So that's why we're excited about the changes that we're seeing, considering that shift in the environment. So just coming on to some of the key themes that we're invested in, we've put some example holdings and the proportion of the funds on the right-hand side. So it's a mixture of cyclical themes, like regulatory easing in the US post the election, higher for longer interest rate environments, that's supportive for bank profitability, both for US and for European banks. A favorable insurance pricing environment for non-life insurers, which we'll come to a bit later on. But it also includes some structural growth themes. So we're seeing interesting themes within exchanges and platforms. So within exchanges, we're seeing them be able to monetize unique data sets. So because of themes that we'll come to later, automation and ETFs and compliance requirements, they're being able to monetize that data set to a greater extent. And then we have the platforms, so benefiting from things like the democratization of retail trading. So more people need to take charge of their savings at an earlier point. And lastly, we have a bucket for turnaround opportunities. So these are quite disparate, but where we see often a franchise trading at a discount to its fair value and where we see a catalyst for change. So moving on to US financials. So this is a screenshot of the Consumer Financial Protection Bureau's website that we took 2 weeks ago. Now, I think they've got the website back up and running since we've took this snapshot. But I think this is just emblematic of probably a shift in terms of how the sector is regulated. So if we think about the statements that have been made by the president, he wants 10 existing regulations repealed for every 1 new regulation that comes in. Think about who is the head of the FDIC now, the head, the vice chair of supervision at the Fed. These are all people that want a more pragmatic approach to regulation. Now, we don't expect regulation to go back to pre-GFC days when it was light touch, but just any shift in that regulatory pendulum, which has been swinging to tightening for over 10 years, is really significant. And it's significant because you probably have more visibility in terms of your surplus capital, so that feeds through into how much capital you can return to shareholders. It has implications for M&A activity, animal spirits, capital markets. That's supportive for a lot of financial subsectors and should ultimately be beneficial for things like loan growth. So I don't think people should underestimate, even a small shift in the regulatory environment is significant. So we think about valuations for financials. This looks at US banks price to book against the ROE on the x-axis since 1991. So you can see two clear groupings. So the red circle is valuations pre-GFC and the blue post-GFC. So you can see for similar ROEs, banks used to trade at much higher price to books. Now, we don't expect banks to go back to 3 times book. They've got to carry more capital. There is a bit more regulation. But we see definitely scope for some of that valuation gap to narrow. And now, not just because of regulation, but also because of what I spoke to earlier about a normalization in the inflation and interest rate backdrop. So the likelihood of us going back down to zero interest rates we think is much lower. And that has implications for bank ROEs. So another area we've been adding to exchanges and platforms. So exchanges, names like NASDAQ, ICE we hold, Hong Kong Exchange. These are beneficiaries of a pickup in volatility. So volatility has been pretty low for a number of years. We think all else equal, it's more likely to see a pickup. But I think more interestingly, on a longer term basis, a number of these companies have changed their revenue model. So on the left, you can see NASDAQ's proportion of revenues that are recurrent is now around 78%. So they own unique data sets. And again, because of that demand for data, they can monetize that. So that could be because of financial crime tech. It could be because of more pull from other data sources. They can increasingly have a more visible earnings stream, and that has implications in terms of the multiple that they trade on. Platforms. So again, another area that we've added to, where we're seeing a kind of cyclical uplift in terms of trading. So as we might get a slight downturn in rates, so that is helpful in terms of trading activity. Again, but there are longer term themes within that as well. So because of that shift from defined benefit to defined contribution, because of the savings gap, because of regulatory reform, government reform, there's a greater push for people to take ownership over their savings as they approach retirement. So those companies that have the best offering, that are transparent in terms of fees, have good technology, so can be innovative, they're seeing really strong account opening growth. So IBKR, which is an online US broker, has seen over 20% CAGR in terms of account openings. We're seeing similar trends for other European names. Flatex is one that we're owning. That's seeing a big pickup in terms of account opening growth. Again, there's talk about German pension reform, which would be very helpful. So that's more of a sort of structural growth trend, which we expect to continue. Moving on to European banks. So this slide looks at the relative price to earning of European banks to the broader markets. And you can see if you go all the way to the right-hand side, there has been a slight narrowing in that discount, but it's only a slight narrowing. So despite the fact they've outperformed over the last 3 years, they're still trading at a 35% discount to the broader market. And that's despite a material improvement in terms of their underlying profitability. So that shift out of 0% interest rates has been transformative for ROEs, now well in excess of their cost of capital. They're returning 10% of their market cap every year on average through buybacks and dividends. They're trading at 8 times earnings, about book value. So they've outperformed, but we think there's much further to go. We're seeing kind of longer term shifts in terms of fiscal policy in Germany, other areas, as they recognize the kind of US security shield may be being reworked. So there are interesting things going on within the region which should be supportive for the banks. And then thinking about turnaround opportunities, again, these are sort of undervalued franchises where we see a catalyst for change. So, value in the sector is not enough. It can't just be cheap. You need to have a catalyst for change. So an example would be, we bought into Barclays last year at around 0.4 times tangible book, relatively new management with a sensible strategy to reallocate capital to the more higher returning businesses and return about £10 billion of capital to shareholders. That was about 40% of their market cap. And when you're buying back stock at 0.4 times book, it's really powerful in terms of tangible book value accretion, earnings per share growth. So we like that risk reward. We've started to see that thesis play out. So those are the kinds of opportunities that we're looking for, and particularly as consensus hadn't bought into their plan as well. So that risk reward we thought was attractive. And then moving on to insurance, we've put on this graph the reinsurers' ROEs against their cost of capital. So you can see in 2023, a big spike in terms of their ROEs. So that's when there was a big change in terms of the pricing environment, a reflection of a higher frequency, higher severity of losses. There's some of that linked to climate change, economic and social inflation. There has been some moderation in pricing since then, but it's quite marginal. So still consistent with sort of mid to high teen levels of ROEs. We think that sort of severity and frequency of losses is probably more durable than just a cyclical thing because of things like climate change, and because of underwriting discipline, they're limiting their ultimate losses. So still seeing a favourable profitability backdrop, and it gives a nice hedge to the portfolio, so less driven by macro cycles. I think also worth noting some of the sort of longer term themes that we're thinking about. So you do your bottom up work, but the sector is changing rapidly. So we need to think about how are people going to engage with financial services as we approach the next decade. So we're investing in a number of these themes. It could be data monetization that I spoke about, the democratization of investing, but that shift from public to private markets as people shift towards alternative assets, we think that is a durable trend, something that will continue into the next decade. And then the sort of obligatory side about AI. Everyone has to have one slide in their presentation about AI. it's always a bit nebulous. No one could quite put a sort of figure on what it's doing. But we are now starting to see companies come out with actual definitive use cases about how they're deploying it. And I think those companies that are really grappling with it, they've got the IT budgets to use it, that's going to be increasingly powerful as we move into the next decade. And that plays into the next slide. So we had a kind of thought experiment. So which lenders do we think are going to be best positioned as we move into the next decade? So you've either got to be, the best tech on the left-hand side. So can you disrupt, the names will be familiar like Monzo and Revolut, or in emerging markets, names like Mercado Libre and New. Or you need to be niche, so focused in areas where you can't disrupt. So that could be buy-to-let lending like Paragon, Esquire, which is a tiny lender, focusing on lending to the legal profession in New York, or doing banking as a service, or that middle section, which is the big beasts, those with the IT budgets to be able to use technology to drive down costs and offer better customer service. So, JP Morgan has a 17 billion IT budget per annum, of which half of that is put into just innovation. So they're starting to come up with some quite interesting use cases. They have 2,000 AI data scientists. Part of the sort of boring part of banking is KYC. Everyone has to do it. It's quite laborious. It's quite expensive. So I think in 2022, they did 155,000 KYC cases with 3,000 people. Through the use of AI, they think they're going to do 250,000 KYC cases next year, but with 20% fewer people. So that's a 90% increase in productivity. Again, a cost saving that will come through. So again, I think we shouldn't underestimate there are real use cases coming through if you have the IT budget to use it. So coming back to the sector as a whole, so valuations. In what is a pretty extended market, the sector is cheap. So trading at 12.9 times PE. On a like-for-like basis, you have payments coming into the sector in 2023 that added about 100 basis points to that multiple. So trading at around 12 times earnings, we think offers good value, particularly given that shift in the underlying environment. It's also the only sector year to date to see earnings upgrades. So whilst there's a lot of unpredictability going on at the moment, actually a higher for longer interest rate environment is pretty supportive in terms of earnings. Had a decent fourth quarter earnings results season. We've seen some earnings upgrades since then. So this slide looks at growth versus value. So the dark blue line being the proportion of global equities within growth, and the light blue being value. So we're now back to the sort of dot-com level in terms of growth versus value. There's been a marginal change with the light blue going up, but from a historical perspective, it's really nothing. We think, as described earlier, there is the ingredients there for a change in terms of market leadership, and investors should be aware of that. So overall, we feel quite excited about the outlook. We think that change in the investment environment is not reflected in valuations, and we think we have the resources within Polar, within the team, and the broader Polar group to capitalize on that. So with that, thank you very much for your attention, and I'll hand over for Q&A.
Lovely, thank you very much. Okay, if you have a question, please raise your hand and wait for the microphone to come to you. Chris, towards the back there, thank you.
Yeah, thank you for the presentation. I'm just interested, what keeps you awake at night, considering the next 3 to 5 years?
That's a good question. I think we're dealing with a lot of unpredictability at the moment coming out of the US. So if a trade war got out of hand and it led to a bit more of a recession, that the sector is sensitive to macro trends, and so a deep recession would clearly be negative for the sector. So unpredictability around that, around geopolitics leading to a downturn in business and consumer sentiment will probably be the key risk for the sector. If our thesis is wrong, so if we expect a normalization in inflation and interest rates, and actually we revert back to what we had for the previous 10 years. So they did QE, rates going back down to sort of negative 0.5, that would clearly be a material risk for bank profitability, and would be contrary to what our thesis is at the moment.
Question at the front here, Chris. Oh, sorry, are you coming this way, are you? Yep, okay.
Thank you.
Yep. please.
Thank you for the presentation. I saw on your slides a company called ICG. I wondered what you could tell me about them, please.
Yeah, so Intermediate Capital Group, so private credit lender. They've been at the forefront in Europe in terms of private credits. I think what's been interesting about them is as banks have retrenched, they've been able to take market share. So they've been able to offer terms to companies when banks have been a bit slow. So we've seen that shift happening within Europe and within the US. What we like about them is they're able to consistently raise larger funds and deploy that sensibly. So the risk management has been good within it. I guess one of the concerns we've had and why we've pulled back a bit from that space overall is that realizations have been a bit slower than we would have expected. But they partially use their balance sheet to lend as well, so they have some skin in the game, which we like. And valuations aren't as high as they are in the US. So we think there is a valuation opportunity at sort of mid-teens PE. So it's a leading space within the private credit lending within the UK and Europe.
Thank you. Question?
Yeah, hi. Could you please tell us a bit more about the tender offer, how it works and how it benefits shareholders, please?
Yeah, so every 5 years you can tender at NAV less costs, so you can fully tender your holding. It's a discount control mechanism, so we had the last one in April 2020. It's likely to have, I can't confirm all the details because they're still to be confirmed, but it's likely to be a similar structure to what it is today in terms of broad structure for the trust. One of the changes which has been proposed and been approved by the board is for an enhanced dividend. So currently it yields around 2.5%. Subject to approval at AGM, there will be an additional 1% paid through capital. So that will be one of the changes that's likely to happen in the rollover.
Thank you.
So just to confirm, George, you said they were every 5 years, and the last tender was about 5 years ago.
Yes, so the next one is not confirmed the exact date, but probably around June this year.
And what's the current discount, if there is one?
About 4%.
4%. Okay, thank you. Other questions, please? Otherwise, I've got a couple here that I thought were quite interesting. I saw on slide AIB, Irish banks. It seems a long time ago since we used to have people talking about Irish banks. What's the outlook for European banks? And the other ones, you had some Italian on there as well. Which countries do you like from the European banks, and why those over other European banks?
Sure. We're overweight European banks in aggregate. I think we like the periphery banks where there's evidence of loan growth coming through. So because of consolidation in Ireland, because of demographics, they are seeing loan growth already coming through at sort of mid-single digits. I think what's important to understand is they're perceived to be very rate sensitive, but that rate sensitivity comes in that first 200 basis points. So that shift out of negative rates to around 2%, that gives you the biggest margin uplift. So if rates trend down to around 2%, which is what the market expects, still a very supportive backdrop in terms of profitability for the banks. They have excess capital. They're returning over 10% of their market cap per annum. And it's still trading at around 8 times earnings. So, there's a valuation case, capital return, and the next leg is going to be loan growth coming through in Ireland.
And on that capital return, you spoke about Barclays and buybacks. Are most of those capital return mechanisms via buybacks rather than enhanced dividends or any other mechanisms?
Yeah, so it's a blend, and it depends on the multiple that they're trading on. But those that still trade at deep discounts to book value are using buybacks quite heavily. But broadly, it splits, kind of 50-50 between dividends and buybacks. I think, AIB is a good case in point. They've now finally got down to like the last 5% in terms of government stake within them. That's allowed them to accelerate that return of surplus capital. Similarly seen with NatWest as well. So it is real, it is coming through, and shareholders are already benefiting from that.
Question here, please.
Thank you. Quick question, or three actually, but they'll be fast. You don't deal in crypto at the moment. If not, why not? Secondly, I note that you do platforms, but why don't you take a really upstanding British company called AJ Bell, and also Aviva, and also London Stock Exchange? And finally, if there's a reduction in regulation, is there a risk, although it has benefits, is there a potential risk to the whole financial sector? Thank you.
Okay, great. So the crypto question. We don't invest directly in crypto. It's too volatile for us. We wouldn't invest directly within it. There are interesting themes around digital currencies and whether regulators would allow them, impact on the banking sector, but they're kind of white papers at the moment. We don't quite know what they will involve. We can invest indirectly through names like Coinbase, Robinhood, Flatex, which we invest in was one on the slide. That's just launched a crypto offering. So we like it if it's incidental, but it's not core to the thesis, if it helps drive account growth. The questions around some of the other companies, AJ Bell, great company, obviously. We have invested in before. We like that theme, the one about, all the reasons that we like the platforms. They are transparent on pricing. They have shown good account opening growth. It was just more a valuation thing. So, we've held it before. We just sold it when we think it got to fair value. LSE, it's a really interesting company. It's actually on our watch list to invest in currently. So we like that data monetization theme. I saw the CEO last week, and he was saying what's interesting about these names is that there is kind of questions about commoditization within artificial intelligence. But there's not within the data aspect. So they have a unique data set. It's verified, it's trusted. You can't commoditize that. So they think that plays into that AI theme. Regulation was the last one, wasn't it? Is there a risk? Yes, if we move to too light touch and it's a bonfire of regulations, I just think that's really unlikely. We're still in a period in which even a slight easing of regulation is contentious. So if they do ease, I think it will be at the margin.
Question towards the back, thank you.
You had the chart with the sector performance. I think if you could just go back to it, I just want to make sure I'm reading it correctly. No, I think you went too far. I'll tell you when to stop. Yeah, that one.
Sector multiples.
Yes. So if I'm reading it correctly, are you saying that financials are now, while in absolute terms their valuation is quite low, but are you saying that right now that orange dot is towards the higher end of their historic performance? Is that what it's saying? And if it is, what's that 10th to 90th percentile? Over what time frame have you gotten that performance?
So I think this is 10-year day. No, this is current PE. So this is forward PE over the last 20 years.
20 years, okay.
And what I said about that was 12.9 times earnings, but on a like-for-like basis. So if you take out payments which came in to the sector in 2023, that adds about 100 basis points to that multiple. So it's trading all else equal at about 12 times. I mean, it's a blend of a lot of different subsectors. So, it's fair to question exactly what that 12 times mean, because are we looking at banks or, but I think the broader point is, in an extended market, we see significant value across financial subsectors. So,
but the only other question I have is it saying that it's at the upper end of its range of historic valuation? Is that what it's saying? When that orange dot is at the top of that?
It is. It is saying that, yeah.
Okay. I'm not making any assertions as to does that mean that it's gone too far, but I was just trying to understand how I've read it. But
so I guess our thesis would be, adjust for the payments coming in. And I'd say the last 20 years is not representative of what the outlook is. So for all the reasons that I spoke about, shift in inflation rates, European, whatever, bank profitability improving, that demands a higher multiple than we've seen, post-GFC.
Yeah, no, I'm a believer. You don't have to convince me.
Do you have any other questions for George? Otherwise, I've got one final one. Question here, please, Chris. Thanks.
I'm primarily an income investor, and one of the attractions now with the proposals going forward, besides the increase in dividend to 4% and NAV, is the change to going to quarterly dividends. I mean, I remember going years ago to an AGM and saying you should go to quarterly dividends. And they said, no, we don't want to do that, too much hassle. So obviously, is the board now thinking of ways to actually attract more retail investors by doing those two proposals?
Yeah, I mean, that is a proposal that's been discussed by the board, but not signed off yet. So I think the shift to quarterly and enhanced has been put forward. Yeah.
When do you know, George, when that would be decided?
So the AGM is in 2-3 weeks. Sorry. It's upcoming.
Okay, not far off then. Okay. Well, George, thank you very much indeed. Thanks for coming this evening. Thanks for the presentation.